As of the close of the regular trading session on Wednesday, July 29, 2026 at 4 p.m. Eastern Time, the United States equity markets are closed, and NU Holdings Limited, trading under ticker symbol NU on the New York Stock Exchange, finished the session at $14.04 per share. That represents an intraday decline of 64 cents or 4.36% off an opening price of $14.52, having touched a high of $14.62 and a low of $13.99 across a heavy trading window. While retail traders watching tickers on the Robinhood app or following Robinhood stock trading discussions might view this 4% slide as a simple pullback following a multi-week run, the underlying market mechanics tell a vastly different story. Wall Street expects digital banking platforms in emerging markets to act like hyper-growth tech plays, scaling rapidly on cheap user acquisition while ignoring traditional balance sheet risks. Reality, however, shows that NU Holdings is operating under an entirely different economic physics model, where credit quality deterioration and Latin American interest rate adjustments exert far more pull on the stock price than raw account creation figures ever could. Most investors looking at NU Holdings see a shimmering success story of digital disruption across Brazil, Mexico, and Colombia. The common consensus on popular investing sites and social finance channels is that as long as NU keeps adding millions of active accounts and converting cash users into digital banking clients, the stock should naturally trajectory upward toward its 52-week high of $18.98. When retail traders review portfolio options across self-investing accounts or configure an intelligent portfolio through Schwab Intelligent Portfolios, high-growth international fintechs often get grouped together with domestic high flyers like Tesla stock or Nvidia stock. Yet this surface-level narrative misses the sharp friction occurring inside Latin American debt markets. The reality challenging this popular expectation is that NU Holdings is no longer just a slick mobile application growing at all costs. It is an immense systemic credit provider exposed to regional inflationary spikes, local currency fluctuations, and shifting non-performing loan ratios that can quickly compress valuation multiples, regardless of headline user expansion. Looking closely at recent stock movement reveals how intensely institutional capital is tussling over these conflicting narratives. Over the past month, NU has swung between $12.94 and $14.85, showing sharp single-day moves on elevated volume. When institutional funds rebalance through individual brokerage accounts, fidelity brokerage platforms, or interactive brokers trading networks, they are actively hedging against macro pressure in Brazil. On sessions where broader markets rallied, driven by strength in mega-cap technology like Apple stock, NU Holdings frequently experienced localized selling pressure. This divergence occurs because major asset managers using Fidelity Investments, Fidelity ETFs, or interactive brokers account tools are tracking yield curves in Latin America rather than just S&P 500 sentiment. When Brazilian central bank commentary hints at sustained elevated interest rates to combat sticky inflation, funding costs for digital lenders shift overnight, prompting rapid portfolio realignments across global equity desks. Trading activity across major brokerage channels illustrates this split in market sentiment. Users executing trades on the SoFi trading platform, utilizing SoFi Invest or managing SoFi stocks alongside SoFi ETFs, often treat dips near $13 as automatic buying opportunities. Similarly, retail traders utilizing Robinhood Investments, Robinhood Cash Management, or picking up Robinhood fractional shares have treated NU Holdings as a top-tier international digital finance pick. However, order book flow on the Interactive Brokers platform reveals that sophisticated institutional desks are utilizing limit orders to distribute shares during rallies toward $15. These institutional traders are keeping a close watch on non-performing loan trends within NYSE's personal credit and credit card books. When credit expansion outpaces real wage growth in emerging markets, delinquency rates inevitably creep higher, forcing the bank to set aside larger provisions for expected credit losses, which directly eats into net interest margin and net profit output. Earnings reactions over recent quarters highlight this exact tension between top-line expansion and credit quality. When NYSE reports revenue figures showing massive top-line gains, the initial market reaction is often a swift pop in early trading, but as analysts on Fidelity Wealth Management calls and institutional researchers utilizing Interactive Brokers' fees analysis tools break down the balance sheet, the narrative shifts toward allowance for loan losses. If provisioning grows faster than net interest income, the stock loses momentum and reverses lower. This pattern was clearly visible in recent trading blocks where volume surged well above 50 million shares on down days, signaling that big funds were actively reducing exposure rather than buying the dip. Comment below how many shares of NYSE Holdings Limited you currently hold in your portfolio and whether you are buying this recent price drop or waiting on the sidelines for clearer macro signals. To properly evaluate where the stock goes next, it helps to understand what NYSE Holdings actually does and how its core operational machine functions beneath the trading floor noise. Headquartered in Sao Paulo, Brazil, NYSE Holdings operates as a primary digital financial services platform across Latin America, serving well over 100 million customers across Brazil, Mexico, and Colombia. Founded in 2013, the company built its brand by offering fee-free credit cards managed entirely through a clean smartphone app, eliminating the notoriously high fees, long lines, and bureaucratic hurdles of traditional Latin American retail banks. After time, the ecosystem expanded to encompass digital savings accounts, personal unsecured loans, insurance brokerage, investments, crypto trading, and merchant payment solutions. By utilizing a cloud-native architecture, NYSE maintains an ultra-low cost to serve per active customer compared to legacy incumbents, creating a structural cost advantage that allows it to offer competitive interest rates while generating solid net margins when economic conditions are stable. Past performance metrics reflect one of the most rapid scaling stories in global banking history. From its initial public offering in late 2021 through recent fiscal reporting, NYSE transitioned from a high-burn startup into a highly profitable fintech giant, generating billions in annual revenue and substantial net income. The platform's ability to cross-sell financial products to its existing user base pushed purchase volumes up significantly while deepening customer engagement. Investors utilizing Fidelity IRAs, Fidelity Mutual Funds, SoFi Active Investing, or Interactive Brokers stock trading accounts watched NYSE turn early operating losses into strong operating leverage. However, historical success in consumer onboarding is now running into the realities of mature market saturation in Brazil, forcing management to seek growth in newer territories like Mexico and Colombia, where credit infrastructure and consumer risk profiles present different operational hurdles. Looking ahead toward future catalysts and scenarios, the path for NYSE Holdings stock will be determined by how successfully management executes its expansion while preserving asset quality. One key catalyst is the company's expansion in Mexico, where it has aggressively gathered deposits by offering attractive yields on savings products while pursuing full banking licenses. If NYSE can replicate its Brazilian operational efficiency in Mexico, it creates a massive second growth engine that could reignite institutional buying and drive shares toward upper analyst price targets above $18. Investors looking for investment help or evaluating online investing options often ask whether international fintechs can sustain high growth without sacrificing risk controls. If deposit growth in Mexico successfully lowers funding costs and fuels profitable loan originations, reality will comfortably beat conservative market expectations. Conversely, significant risks remain tied to regional macroeconomic volatility and regulatory adjustments. A sharp economic slowdown or persistent inflation across Latin America would likely trigger higher delinquency rates among lower-income borrowers, forcing elevated credit loss provisions that compress return on equity. Furthermore, potential regulatory shifts regarding credit card interest rate caps or interchange fees in key markets could directly impact fee revenue and interest spreads. For self-directed investors managing portfolios via the Fidelity mobile app, Fidelity trading platform, SoFi robo-advisor, or various online investing portals, these risk factors mean NU cannot be treated as a passive growth holding. It requires continuous monitoring of credit metrics, net interest margins, and local macroeconomic policy. In closing, Nu Holdings